Everybody, welcome to today's fundamentals. Hello, Peter.
Hello.
A new day, a new week. What's new in the FX market?
Well, on a fundamental level, I would be noting that we have still extensive market worries for possible recession in the US economy. I would be noting, though, that despite the market worries, we had the release of the preliminary PMIs, S&P Global PMI figures for April. And for the US, actually, the picture was better than expected. Both the services as well as the manufacturing PMI figures were on the rise. And that's in a steep contrast, say, for example, with Europe, where we had, say, for example, in the Eurozone, Germany's manufacturing sector economic activity dropping even deeper, contracting even more, creating some worries there. The same applied also for the UK, but on the other hand, the UK, we had improved readings on the services sector PMI figures, which more or less tended to imply that, given that the UK economy is based more on the services sector, that economic activity has picked up. So that was a positive. Other than that, I would be noting that we had an easing, a very slight, subtle easing of inflationary pressures in Japan, which may have weakened a little bit JPY. I would be noting BOJ Governor Ueda's comment that he would like to see a quite strong inflation figure before actually tweaking the bank's yield curve control policy, which tended to weigh on JPY somewhat. It sounded a little bit more on the dovish side.
And how about US stock markets?
US stock markets ended the day mixed on Friday, very little volatility. I would be noting that stock market participants have to navigate here practically between three factors. A, we have the market worries for a recession. B, what are the Fed's intentions? Is it going to continue hiking, and to which extent? And C, the earnings season. We had earnings reports which tended also to provide some mixed signals. They weren't quite as convincing as we have hoped for. I think that the current week is going to be dominated by the tech sector. We have a number of high-profile companies who are releasing the earnings reports, but we would be focusing definitely on Tuesday. We get Google, that's one. I would be also noting Microsoft on Tuesday. On Wednesday, we're getting Meta, Facebook. And on Thursday, we're getting Amazon. So practically, should we see better than expected readings, given also that we had a number of companies which had laid off people during the early quarter one, so any economies of scale should be kicking in right now in quarter one. That could improve market sentiment somewhat. Otherwise, we may see market worries for possible recession intensifying even further.
And how about gold?
Gold dropped on Friday. I would like to note here that we may be seeing an adverse correlation with the US dollar once again, but it was a little bit disproportional. So for the time being, I would be highlighting that any financial releases, given that we have a Fed blackout period up until its meeting, especially in Fed financial releases coming from the US, could also have an effect on gold's price, given that they could move the US dollar.
And what's new regarding oil?
Oil tended to hold its drop on Friday. However, that was temporary. It was characteristic that during today's Asian and early European session, the drop restarted. Market worries for possible recession have a negative effect also for the demand side of the commodity. So overall, we see the case for a bearish outlook on fundamental level for the oil market. That's up until we see some signs from the supply side that may push the market towards a more tighter environment, and that could provide some support for oil prices. Other than that, for the time being, we do not see any factors which could provide some support.
And what's on today's calendar?
It's an easygoing Monday. We had already some releases from Germany. I would be noting during tomorrow's Asian session the release of Japan's chain store sales. I wouldn't expect much there either. Overall, I would expect fundamentals to lead the way, given the low number of high impact financial releases.
And how about the rest of the week?
It's going to be an easy start for the week, Monday and Tuesday, but I think that we may see some interest being revolving around on Tuesday around the US consumer confidence indicator. Should there be an improvement, we may see the US dollar rising and vice versa. On Wednesday, I would be noting the release of Australia CPI rates. Therefore, quarter one, a possible deceleration could weaken the Aussie, as that may more or less reinforce the possibility that RBA will be remaining on hold. Other than that, I would be highlighting from Europe, from Sweden, Riksbank's interest rate decision. The bank is expected to hike rates possibly by 50 basis points, and that could provide some support for the SEK. On Thursday, I would highlight the US GDP rate. It's the preliminary release, it's the advance rate, it's for quarter one. And a possible acceleration could provide some support for the US dollar. Otherwise, should the rate slow down, we may see the USD weakening, as that would intensify market worries for possible recession in the US economy. Also on Thursday, we're getting from Turkey CBT's interest rate decision. Any rate below 8.5% may enhance the bearishness on TRY. Mind you that the Turkish lira has been weakening for a while now, since the start of the year. And it's quite worrying where it's heading to. And I would be finishing the week with a packed Friday. We have from the Eurozone GDP rates and preliminary HICP rates from France, Germany, and the Eurozone as a whole, which may create substantial volatility for Euro traders. In the American session, I would be noting from the US the consumption adjusted rate, as well as the core PC price index. While from Canada, we're getting the GDP rate. It's on a month-to-month basis, and it's for February.
Great. Thank you, Fidel, for your time, and everyone for watching. Join us after a short break for technical analysis with Fidel Yosif.
Hello, welcome to the technical analysis part of the presentation. Now, my name is Peter Yusuf, Senior Market Analyst at IronFX. In front of your screens, you have the WTI. Let's switch that to the US dollar index. We can start with that. Now, in front of your screens, now you have the US dollar index. It's the 4-hour chart. All charts to be presented are to be of the same time frame, unless otherwise stated, by the way. It's characteristic how the US dollar index has dropped below the reading of 101.55, the S1. Hence, we have to definitely switch this into a resistance line. And it's still dropping. Okay, let's go hunting for a new ultimate resistance level. Going further back. Here you go. I would be noting this true here. It has also peak, a peak, a peak. Okay, it seems to be valid. And that would be the 9905. 9. Readjusting the chart. Repositioning the labels. Let's work the content. Starting with the R3, which is now being placed at 103.45. The R2 at 102.45. The R1 at 101.55, which has been broken clearly now. The S1 at 100.65. The S2 at 99.80. And the S3 at 99.05. Locking everything in. Okay, what do we see here? We have some conflicting tendencies. It seems that the US dollar index is about to break its sideways movement, which has been revolving around the 101.55. The bearish candlestick, the last one, in the European session seems to be indicative of that movement. The RSI indicator has started to drop and places some distance between itself and the reading of 50. It's actually nearing the reading of 30. It's right now at 41.0. So there are some bearish tendencies for the index. On the other hand, note how the price action has broken below the low Bollinger Band, which may slow down somewhat the drop, may provide some difficulties for the bears here. Should the bears take over, I wouldn't be surprised to see the price action aiming, if not breaching, the 100.65, and should the S1 be broken, then practically the way is paved for the 99.80. On the other hand, should the index stabilize, I wouldn't be surprised to see it resuming once again a sideways motion, tight range bound sideways motion, just below the 101.55 resistance line. For a bullish outlook, we may see the price action reversing direction, breaking the R1 101.55 once again, and start aiming for the 102.45 resistance level. The level which provided resistance beautifully here. It was kindly noted as well here. So it's a pretty valid level. Okay, let's move to Euro USD. Euro USD, which seems to be on the rise. Note how it's flirting constantly with the upper Bollinger Band. Also, the RSI indicator has reached the reading of 62. So there may be some slight bullish tendencies. Should the bulls clearly take over, we may see the price action rising, breaking the R1 1.1075. In that case, the next possible stop for the bulls may be the 1.1220. I would like to see where the R2 actually rests on. Give me a sec, let's go back a little bit. It has to be pretty far back. Okay, the last time where the R1 saw any price action was in January this year, early January. Sorry, it was in April, end of March, April last year. Okay, my bad. While the R2 was tested here, and that was on the 28th of February last year. So should the R1 be broken, then we're talking about a 12-month high. Okay, may provide some difficulties for the bulls here. Nevertheless, move back. I would also like to see what the release was in today's IFO indicators from Germany, if there was any market reaction. Back down to the, drilling down to the minute chart, widening it. No major market reaction. It seems as if the pair was already on the rise. And let's have a look at the release as such. Overall, they were better than expected, with the exception of current assessment. So practically we had an improvement on the expectations regarding the next 6 months in Germany. On the other hand, the conditions on the ground had a slight deterioration. Okay. The overall business climate did not rise as much as the market had expected. So we had some mixed signals here. It's understandable. Okay, back to the forward chart. Let's talk direction about the Euro USD. Before that, let's readjust the chart. Okay, some bullish tendencies seem to be present, but for a bullish outlook, I really would like to see a higher peak than this one. So the pair has to rise, break above the R1 1.1075, which would practically allow it to start aiming for the 1.1220. Should the pair be unable or fail to actually break the R1, I would maintain a sideways motion bias, with the movement being between the R1 and the S1 1.0925. For a bearish outlook, I would require a reversal of the upward movement definitely, and a breaking of the 1.0925 support line, a level which provides support here, here, resistance here, here, and here. So that's pretty valid as well. And should the S1 be broken, we see as the next possible stop the S2 1.0760. For the time being, though, we highlight the bullish tendencies of the pair. It's an issue which could allow the bulls to actually take over, especially given the RSI indicator, which seems to be on the rise. On the other hand, the fact that it has hit the upper Bollinger Band may provide some hurdles for the bulls here. Also, the fact that the R1 is a 12-month high, it's an issue. Yes, when I'm saying about the 12-month high, I mean behind the peak here, definitely. Okay, let's have a look at cable. Similar bullish tendencies, but a little bit more restrained. I think we're talking about a clear-cut sideways scenario here between the R1 1.2540 and the 1.2350 support line. So we would be talking about a sideways motion here. It would be a very tight range bound motion. Note how the Bollinger Bands, in contrast, say for example Euro USD, have failed to actually widen, diverge. They remain very, very tight, exactly describing or reflecting, if you prefer, this lack of volatility. And let's color the sideways motion once again. Okay, this is our expectation. On the other hand, the RSI has jumped a little bit higher than the reading of 50. It's actually right now at, let's have a look, 56. Yeah, okay, it's not bad, but it's not sufficient for a bullish scenario yet. For a bullish scenario, I would require a higher peak than this one. Yeah. So practically, the pair has to rise, break the R1 1.2540, which would allow it to start aiming for the 1.2770. While on the flip side, for a bearish scenario, I would require the pair to drop, break the lower boundary of its current sideways motion. A lower true than this one would be required. And that would allow it to start aiming for the 1.2185, a level that provided support here and here, as it has also provided resistance here. Let's have a look also where the R2 is resting. We're going to have to go a little bit further back. Quite back. Here in this peak here. Once again, for the time being, we tend to maintain a bias for a sideways motion to continue between the R1 1.2540 and the S1 1.2350. Actually, we're quite large regarding the distance between the sideways channel. The price action has maintained a much tighter range-bound movement in the past few days. But overall, we note the highlights to the ups and the downs. Moving now to USD/JPY. USD/JPY, which seems to maintain a sideways motion just above the 133.70 support line. It's going to be an interesting read. On the other hand, I have to note to you guys that the boys in research highlighted to me the following, that there is an upward trend line like this. And they also highlighted the following, that we have consecutive higher peaks, like once here, and the second would be here. That's clear. On the other hand, we have also consecutive higher truths. Allow me to color this in dark blue. And the last one being practically on Friday here. So under normal circumstances, given the upward trend line, I would expect the price action to move above this peak here and practically test, if not breach, the 135.70. On the other hand, though, note that the pair seems to have difficulty actually creating a higher peak than the last one. The RSI indicator is just above the reading of 50, it's at 53.6. So more or less there seem to be some signs of stabilization. Nevertheless, should the bulls actually maintain control or regain control if you prefer, we may see the price action jumping, breaking the R1 135.70, which would be paving the way for the R2 137.80 level, which provided or is resting practically on this peak here. On the other hand, should there be a stabilization, I wouldn't be surprised to see it remaining between the R1 135.70 and the S1 133.70. So that may imply a sideways motion, which would be ultimately breaking the upward trend line we have just drawn. For a bearish outlook, I would require the pair to drop, break the upward trend line we have mentioned. That would be once again signaling a change of trend, or at least that the upward movement has been interrupted. But I would also require a lower trough than this one. So it would have to break below the S1 133.70, which may actually allow us to start drawing a downward trend line and showing us the limitations of the downward movement. For the time being, I highlight the stabilization of the pair, and that's an issue. Okay, let's move to the other safe haven currency pair, that will be USD-CHF. Okay, there is a downward movement. Now there are two conflicting points here. On the one hand, okay, definitely we have to switch the 0.8935 from a support line to a resistance line, given that the price action is below it. So let's set our limitations straight first. And let's move to the S3, or at least go hunting for a new S3. Give me a sec. Further back. This is the S1. This is the S2. Okay, we have to drill into the daily chart. If we continue like this, it's going to be a new record low. Practically. Oh. Okay, ladies and gents, we're going back to 2015. Practically new record low. What you see here is the daily chart, and this is the day where the Swiss National Bank actually intervened in the markets. It's impressive how back it goes. Oh my god. We are at very, very low levels. Okay, this would be the in green, the 0.87, sorry, 8680. Locking it in, readjusting the chart, drilling out to the 4-hour chart, readjusting it as well. Let's correct the labels. Starting with the R3, which is now being placed at 0.9220, sorry, 9115. The R2 at 0.9020. The R1 at 0.8935. S1 at 0.8860. The S2 at 0.8760. And the S3 at 0.8680. Locking everything in. That's it. Now there are two ways to view this. The first would be to view that there is a clear downward trend line which has started since the March the 8th this year. I think it's clear how the pair has consecutive lower peaks. And despite some difficulty of marking lower trows here, it managed to drop below it later on. So the next one should be lower than the S1 0.8860. For the time being, we tend to maintain a bias for the bearish movement to be maintained despite the possibility of some stabilization. Also note how the RSI indicator is actually pretty low. It's at 32, also implying a bearish sentiment. On the other hand, the price action has reached the lower Bollinger Band, which may slow down the bears somewhat. But should the bears maintain control as we expect, then we wouldn't be surprised to see the price action dropping, breaking the S1 0.8860 and start aiming for 0.8760. The pair is though at very low levels, I have to note that. So we may see it stabilizing between the S1 and the R1, 0.8935 and 0.8860. Now for a bullish outlook, I would require the pair to rise, break the R1 0.8935, but also I would require it to break the downward trend line guiding it since the 8th of March. So it would have to be a movement like 1 breaking the R1 0.8935, breaking also the downward trend line, which would be signaling exactly the interruption in the in the downward movement, and start aiming, if not even reach, the 0.9020, a level which used to be support line, but given that the price action has turned below it, has now turned into resistance line. It's a very, very interesting chart. Okay, let's have a look at commodity currency AUD/USD. The beautiful sideways motion continues, ladies and gents. No surprises here. We remain between the 0.6755 and the 0.6625. Correct a little bit, reposition practically the labels a little bit, so we get a slightly clearer picture here. For the time being, we tend to maintain our bias for a sideways motion to continue between the pre-mentioned levels. That should be clear by now, despite this breaks here once, twice. But overall, the wide majority of the price action, the main body of the price action, since around the 14th of March remains between the 0.6755 and the 0.6625. The RSI indicator, okay, it's below the reading of 50, it's actually at 45, but nothing convincing for a bearish outlook just yet. For a bearish outlook, we would require the price action to drop, break the S1 0.6625, and start aiming for the S2 0.6520. On the flip side, should the bulls take over, we may see the price action rising, breaking the R1 0.6755 and start aiming for 0.6855. We're talking about a space of around 130 pips between the R1 and the S1. So that would allow for some fluctuation to coexist with the borderlines of the current channel movement. Let's have a look at USD CAD. The picture is very different there, albeit CAD is also a commodity currency pair. Here you go. You can see some consolidation over today's Asian and early European session. Let's readjust the levels though. Seems as if the pair has hit the ceiling at the R1 1.3545. However, the correction lower was partially at least expected, given that the RSI indicator has reached above the reading of the RSI indicator has reached above the reading of 70. Now has corrected slightly below it. It was at 79 and has dropped to 66. But the bullish outlook is still there, given that the upward trend line is still present. In which case we may see the price action breaking clearly now the 1.3545 and start aiming for the 1.3645, the R2, which is about 100 pips higher. On the other hand, should the pair stabilize, I wouldn't be surprised to see it breaking the upward trend line and remaining just below the R1 1.3545. For a bearish outlook, I would require the pair to drop, break the upward trend line, once again signaling that the upward movement has been ended, and start aiming for the S1, if not actually reaching it, the 1.34 support line. Okay, let's have a look also at the Kiwi, given that we have New Zealand's trade data. Okay, some readjustment has to be made here, definitely. But overall, the picture does not change, in the sense that there is a downward trend line. The price action seems to have stabilized and is about to break the downward trend line, guiding the pair. And that's since, let's have a look, for the past 2 weeks. Yep, since the 14th, past 10 days, since the 14th of the month. So the stabilization seems to be present. It's going to be interesting to see if the price action will be able to clearly break the downward trend line, and that would force us to actually switch our bearish outlook in favor of a sideways motion, probably between the 0.6190 resistance line and the 0.6090, despite there being a very tight range bound movement over the past 24 hours, actually since early Friday. The RSI indicator, though, is still below the reading of 50. It's actually at 42, slightly rising. There is a residue of bearish sentiment in the market, it seems so. But overall, I would say that the effectiveness of the bearish sentiment is slowly fading away as the RSI indicator is nearing the reading of 50. For a bullish outlook, I would require the price action to rise, break the R1 0.6190, which will also form a support line here and here, and start aiming for 0.6270. On the other hand, should the bears regain control, we may see the price action of NZD-USD dropping, breaking the S1 0.6090 support line, which was practically providing support here and here. You can see how the pair tested this level twice and jumped back up in a classic inverted W formation. Nevertheless, should the S1 be broken at 0.6090, then we may be talking about 110 pips lower, the next support line being the S2 0.5980. Let's have a look at gold. There was an interesting drop yesterday. actually on Friday, sorry. And drilling out to the 1-day chart, I think this drop here was very, very indicative and it's characteristic. For the time being, back to the forward chart, the price action seems to be fighting once again with the 1985. The bearish sentiment is slowly easing as the RSI indicator is okay, low, but still aiming for the reading of 50. So some stabilization could be in play with the price action revolving around the S1 1985 support line. For a bullish outlook, I would require gold's price to rise and possibly break the R1 2031, a level which provided the resistance here. While on the flip side, should the bears take over, we may see the price action dropping, possibly testing if not breaching the 1935 support line, a level which provides support here and resistance here. For the time being though, I wouldn't be surprised to see the precious metals price maintaining a sideways motion revolving around the S1 1985. Let's have a look at Dow Jones. Moving now to US stock markets. Okay. There is, or at least seems to be, a very subtle downward motion. You can see it like this. Or even better, like this. However, allow me to drill into sorry, the 1-hour chart where it becomes clearer. Widening it. Okay. However, note how the pair is failing to make substantially lower truths. And that's an issue. It may imply that the pair has started to stabilize. It's characteristic how the RSI indicator in the 1-hour chart has reached the reading of 50, which may imply a rather indecisive market. Back to the 4-hour chart. Should the sideways motion be maintained, I would expect it to remain between the 34,160 and the 33,500. On the other hand, should the bears maintain the upper hand, I would expect the index to continue to approach the S1 33,500 in a very slow-moving, subtle manner, unless there are any surprises for the market which may intensify the volatility. For the time being, and given the past 4 days, I would be noting the low volatility in the index. Let's have a look also at S&P 500. That would be US 500 cash here. In a similar movement, note how the price action is dropping, and that's more clear if we drill once again into the 1-hour chart. Let me widen this a little bit. Once again, the same lowering peaks, but a difficulty to create substantially lower truths. So that may imply some stabilization. Also note that the RSI indicator in the 1-hour chart this time has also reached the reading of 50, implying a rather indecisive market. Should the price action stabilize, I would expect it to break the downward trend line we have just shown. Otherwise, I would expect the price action to continue its slow drop towards the 4,080 support line, which is still pretty far off, so it may take another day or two to reach it at the current rate, and should the bearish movement be maintained. On the other hand, should we discuss a bullish outlook, I would require clear breaking of the downward trend line we have just mentioned, but also breaking of the R140 135 and the price action of S&P 500 aiming for the R2 40 195. And let's have a look at Nasdaq. Once again, similar picture, nothing changes here. The same subtle downward motion, the same indecisiveness of the market at the current stage. I would maintain my bearish outlook. Note also once again how the pair is having difficulties creating lower truths than the last one. But should the bears maintain control, then we may see the price action being forced towards the 12,850 support line, and if broken, then practically the way is paved for the 12,520. Note how it provided support here. On the other hand, should the index stabilize, we may see the price action breaking the downward trend line and respecting both the R1 13,145 and the S1 12,850. For a bullish outlook, I would require the price action to rise, break the downward trend line we have mentioned, and also I would require a break of the R1 13,145. It has to be a clear-cut break. There should be no hesitation. In such a case, we may see the price action start aiming for the 13,400 resistance level. Let's have a look where that actually rests, drilling out to the daily chart. Nice peak here for the R1. Nice peak here for the R2. Okay, they both seem to be pretty valid. Back to the forward chart. Let's have a quick glance also at WTI before we leave. WTI, which seems to be stalling its downward motion, it's very interesting, especially the slight rise today during the European session. It's very, very fresh. The downward motion, though, was characterized by this downward trend line. So I would say that it's still valid. And it's going to be interesting. There is a stabilization as the RSI indicator has bounced on the reading of 30 and is now aiming for the reading of 50, implying a rather indecisive market should it reach the reading of 50. Otherwise, and should the bears maintain control, I would expect the commodity's price to break below the 76.20 support line and start aiming for 71.65. So that should sum it up from all of us here at IronFX. Best wishes for solid trading.
Hello everyone! The term risk-off refers to the mood of traders and investors in the financial market when they want to avoid risk exposure and safeguard their funds. When traders are pessimistic about the economic outlook, they tend to sell risky assets and buy safe haven assets. In such an environment, safe haven assets like the Japanese yen and gold tend to gain in value, while high-risk assets like stocks and commodities tend to decline. Markets are frequently labeled as risk-on or risk-off. Both of them express global market sentiment. Risk-on, risk-off is frequently abbreviated as RORO. This happens when price behavior is driven by investors and traders' changes in their risk tolerance. When traders are not optimistic, then they tend to reduce leverage, selling risky assets and buying safer assets, or even preferring cash. US Treasuries and German bonds are considered almost risk-free. The US dollar, Japanese yen, and the Swiss franc are safe havens and tend to rally when traders want safety during times of uncertainty. The price of gold usually increases and the yield on government bonds falls. Thank you so much for watching us today, guys. Stay tuned. Bye-bye.
All right. Okay. I think we're ready to kick off. All right. Okay. So today's webinar series by IronFX is about fundamental trading strategy. So once again, the information in this webinar is purely for informational and educational purposes. Please do not construe it as investment advice or investment recommendation. And please do all due diligence prior to uh, putting on any trades across any asset class, right? Okay. So the full risk warning and disclaimer is here on this page. Okay, so this webinar is brought you together in partnership with EFG Everest Fortune Group. We're the finalists for Best FX Research from 2019 through 2021, Best Equity Research in 2020 and 2021. So I'm your host today, Ketan, and let's start things off. Okay, so over here, we have a slide on the data links for where we can get fundamental information about the United States. All right, feel free to take a screenshot of this, but also not to worry. All these other links here can be found on Forex Factory. So basically, you guys just need to know and remember Forex Factory. And once you're on that site and you search for the economic calendar, and I will also teach you how to search for the respective economic news events, and from there we are able to find all the sublinks. Okay, right, so do not worry, you can take a screenshot, feel free, but the main link to look out for is Forex Factory, right? Okay, so let's go and go into Google. All right, okay, so here we have Forex Factory, right? Okay, just a quick note, you guys able to see the page, Forex Factory? Yes. Just maybe a quick show of hands to see that you're able to view that page. Right. Okay, wait, hang on. Yeah. All right, guys. Sorry. Okay, I assume everyone can see my Forex Factory page, right? Okay. So if that's the case, let's continue. Okay, right. Okay, so here we have Forex Factory. Depending on your time zone, it will give you the time. Okay, today is now. Okay, I've not refreshed the page, so let me refresh the page. Hang on. Okay. Yeah. Okay. So this is 6:05 p.m. UTC plus 8. So this is Singapore time. Today's date is 12th of April. Right? Okay. So now let's just start. Okay, we're going to look at US fundamental data. Okay, so Forex Factory is a good website, and with its economic calendar, which is on the homepage, right? So if you come to Forex Factory, I just do a Google search, Forex Factory, right? It will take you to, oops, sorry, hang on. Wait. Yeah, okay, yeah. So if you do that, yeah, you search for Forex Factory, it'll come here, right? And on the homepage, okay, let's just refresh the homepage. Okay, if you click on home, it'll bring you to the main page here, and this is the economic calendar right here. Okay, so what we're going to do is we're going to uh, look through, for example, let's just start quickly uh, through the month of March. Okay, so we had the FOMC meeting, right? The Federal Reserve had its interest rate meeting in the second last week of March, right? So 22nd and 23rd of March was the meeting. So let's start the calendar from 20th of March till the present date. Okay, and let's just filter to look only for US related events. Okay, so we'll cover the the events that will have the most impact, right? And we'll cover all the event types and just US. Right. Okay, so this brings us to our starting date, March 20th. And we have a list of various economic events for the US. Okay, so because we are looking at foreign exchange FX, we'll be looking at what central banks are doing. So the FOMC is a big uh, event led by the Federal Reserve, which is the largest and most influential reserve central bank in the world, right? Okay, so let's quickly look at that. So we have this event here, March 23rd, 6:07 this is obviously UTC time. So this, because we're UTC plus 8, this will show us as Thursday, March 23. Okay. Now, if we look at the we have the federal funds rate. All right. So if you click on this folder here, it tells us the source of the data and the links and a description. Okay, so I think you guys should be pretty familiar with this. And also, if we click on the graph here, it will tell us the history of the interest rates as well. So how the Fed raised interest rates in 2016 all the way till early 2019 before cutting them and bringing them down to zero because of oh, sorry, not zero, but very close to zero because due to COVID. And then after that, in order to combat inflation, they started uh, raising interest rates very aggressively. This is this period has been one of the fastest, or if not the fastest, rate of interest rate hikes, which has caught many people off. Even though the Fed did forewarn markets that they would uh, aggressively raise interest rates to combat inflation. Okay, so now we have this here. Okay, so if we click on the folder, we click on latest release, it takes us to the Federal Open Market Committee website, right? Uh, so that's what FOMC stands for, Federal Open Market Committee. Over here, we are able to find out the calendar meetings for 2023. And as you can see, the next meeting or the third meeting for this year will run from 2nd to 3rd May. So from now till then, we've got about uh let's see, what, 3 weeks. Yes, 3 weeks, about 3 weeks before the next meeting comes up, and all eyes will be on Chairman Jerome Powell. And also we are able to view uh the statements, the history, the historical statements, and press conference. So if I click on PDF, you are able to read the full press conference, press statement in detail, as well as view the press conference as well. So there's a YouTube video here, which you can, if you choose to, you can read through it as well to determine exactly what uh, uh, the chair Jerome Powell was saying, because his impact, his words during the FOMC meeting can have a meaningful impact on markets moving forward, right? If he's sounding very hawkish or dovish during the meeting, it can have a meaningful impact on currencies, right? So when we say hawkish, it means him and his other committee members are looking to further increase interest rates. And if it's dovish, it means he could be pausing interest rates or uh, cutting them. Okay. So we have the FOMC website here. So one of the things to look at is what central banks are doing and when are the meeting and when are the upcoming meetings. So the Fed is the biggest central bank, and it's important to see how they are raising interest rates. So as you can see here, we have now reached 5% at the after the last meeting in March. Okay. Another thing to look out for would be, right, as we scroll down, there's also other economic data. Something that we would also need to see is GDP numbers, right? So if the US economy is strong, GDP is strong, we can expect the Fed to still continue raising interest rates if they need to do so, right? If the economy is stalling, we have negative growth or negative quarterly growth of GDP, then something is wrong, right, with the economy, and the Fed is very likely to pause or even cut interest rates, right, which would further weaken the dollar, weaken bond yields, and drive the dollar index lower against its major currency pairs. Okay, so if you look at GDP here, so you can see GDP after the COVID lockdowns, GDP rebounded strongly in December 2020. I believe this should be the fourth quarter of 2020 or the third quarter, this result. And then uh, it's been growing pretty steadily. And in first half of 2022, okay, so this is Q1, Q2, sorry. Okay, although this is saying here June and September, but this is actually the GDP data for Q1 and Q2 of 2020, where we had 2 periods of shallow negative growth, which constitutes a technical recession, right? And then followed by a strong rebound in the second half of 2022, where growth bounced back to about, what is it here? Let me see. Okay, 3.2% and 2.6%. So we have strong growth to end 2022. All right, okay. Okay, so now we shall close the graph. And if we click on the folder, right, it'll show us that the source for this piece of information is the Bureau of Economic Analysis. If we click on latest release, it'll also take us here. So you can see the latest GDP data was announced on 31st March. And you can find out more details. Oh, wait, sorry, this is by state. It should be this one here, sorry, on the 30th of March. Okay, so you can give us more details and information regarding the state of the economy. So after looking at what central banks do, we look at GDP numbers as well. The next piece of information to look out for would also be ISM manufacturing numbers, right? PMI numbers for services sector and manufacturing sector, right? Because GDP is announced on a quarterly basis, although you do have updates along the way, they are not as regular. The data is not as regular as other agencies. So if you look at ISM PMI manufacturing, right, we click on it. ISM stands for Institute for Supply Management. click on latest release, it takes us to their website. Okay, so accept cookies. So we have PMI reports, purchasing managers index reports for the manufacturing services sector and hospital. Hospital was something relatively new that came up just after COVID, but we will look at more on manufacturing and services. So if you click on view charts for both manufacturing and services, right? Are you okay? It takes us to shows us the overall state of the economy on a monthly basis. This is for the manufacturing economy, manufacturing sector, where we can see manufacturing has actually been contracting since the third or fourth quarter of last year and is still in a contraction zone. So any reading below 50 means that this sector is contracting, and any reading above 50 means this sector is expanding, right? And here you have the sub indices as well: new orders, production, employment, inventories, prices. So one of the reasons for, okay, so similarly, this is for services sector. Services are still expanding uh, pretty steadily, although the latest result dropped to 51.2, but is still in expansion territory. So you can see the US economy is being held up by the services sector, right? And also let's open this up. Okay, so you can see there's similarly for both manufacturing and services sector, there are sub indices such as new orders, employment, prices, imports, exports. So what I'm going to zoom in on here is the prices indices, right? Because the main reason central banks are raising interest rates is due to inflation, right? Rising inflation. And in order to combat inflation, the Fed can only do one thing, and that is to raise interest rates, make lending more expensive for corporates, for retail, for households, right? They have a very blunt tool, and that's the one of the primary tools that they can use to try and combat inflation. Okay, so why is prices important here? The prices sub-index for both manufacturing and services, right? So if we scroll further down, right, so you can see throughout from early 2021, the prices index for the manufacturing sector was already at pretty high levels, right? It was almost, this looks at, yeah, almost 90, right? Almost 80 plus onwards. So the prices indices were already elevated throughout 2021, which should have uh, signaled to the Fed that probably was already time to raise interest rates in uh, 2021 instead of waiting all the way till the start of 2022. So the prices indices for the manufacturing was elevated. Similarly, we should see something similar for the services sector as well. The services sector prices were also increasing pretty rapidly and remained constant throughout uh, 2021, 2022 until the middle of 2022, where it has been descending pretty steadily as interest rates were raised. So similarly, for the manufacturing sector as well, the prices indices were also dropping. So what this means to say that is the rising interest rates by central banks, especially the Fed, made borrowing expensive uh, for corporates, for manufacturers, and all other participants. And when things become more expensive, generally demand pulls off. So as demand pulls off, price will start to recalibrate and probably uh, trend lower. So as demand pulls back, prices for in the manufacturing sector and services sector started pulling back. So you could see the effect of um, inflation or the effect of rising interest rates on the prices indices of the services and manufacturing sector. So this is important because this also relates to the overall CPI numbers, right? Inflation data. So as prices fall, CPI falls, the the job of high interest rates or the tool of high interest rates has helped to slow down inflation. So if you look at annualized inflation, right? And speaking of inflation, that is the number that is coming out today, right? 8:30 p.m. UTC plus 8 is where the Fed, sorry, not the Fed, the Bureau of Labor Statistics, BLS, will announce their inflation figures for the month of March, right? So just before we jump into inflation, we can also look at sorry, where is it? Non-farm employment change, okay, and the unemployment rate. So another important fundamental factor to look out for the US is the employment reports. So this is the non-farm employment change and unemployment rate. So similarly, if you were to click on latest release, right, it takes you to this page. So basically, Forex Factory is the primary website that you need to remember, because all the other sublinks can be found on their website. So it takes you to, so we clicked on employment non-farm change. So it takes us to this page. Okay, it's always easy to visualize data or information through a chart. So if you scroll right to the bottom, you will see a link for news release charts. Okay, so let's just click on that. Okay, so the first chart that it shows us is the civilian unemployment rate. So as you can see, after spiking as high as 14.7% in April of 2020, as economies reopen, uh, jobs, companies started hiring again. The unemployment rate fell pretty sharply and steadily, and has been hovering between 3.4 and 3.7% for the past, nearly a year now, right? So despite uh, the tech layoffs that we've been hearing about a lot, unemployment rates are still historically low. And this tells us that the tech sector is just one uh, industry in a wide range of other companies, right? So it may not be uh, the tech layoffs, although they are high in absolute numbers and in relative numbers to the size of the company, it's not representative. It's not representative of the entire American workforce, right? So you can see unemployment rates have been pretty low. So this tells us, together with uh, non-farm payments. Okay, so non-farm would be, yes, here, employment by industry, I believe. So click on employment by industry, click on go. Yep. So this gives us total non-farm figures, right? So if we just take out private, is just a subset of non-farm. So we shall just look at total non-farm. So as you can see, after the huge drop uh, in the workforce, right? The workforce numbers, they have surpassed the pre-COVID highs and are making all-time highs here. So basically what you're seeing for the month of March, there are a total of 155 million Americans currently employed. So by looking at unemployment levels, which is the total non-farm figures, and the unemployment rate, it tells us that the workforce is strong, the labor market is tight, so the Fed can still continue to raise interest rates if they wish to do so, right? Because if unemployment rates are rising drastically, non-farm numbers are dropping, it tells us that more people as a whole are being laid off. And this is a scenario where the Fed may actually start to pause or even start to cut interest rates. So this is another economic data point that is worth monitoring, and to understand the rationale behind the Fed's movement, right? Or the Fed's actions, rather. Okay. So next, okay, so before we go into the last one, which is CPI. So we've looked, just to quickly cover or to review, we've looked at the FOMC events where the Federal Reserve raised interest rates. It's important to know how much they're raising interest rates. And it's also important to look at their statements and the press conference to see how hawkish or dovish the committee members are. They would also look at GDP numbers to see the actual overall strength of the US economy. But because GDP numbers are released on a quarterly basis, right, they do not give us timely information, whereas other agencies or information sources such as the manufacturing and services PMI numbers give us a monthly update. And then we can also look at non-farm employment change and unemployment rate, which finally brings us to another important fundamental indicator, which is CPI or inflation. All right, so if we click on CPI in the folder here and click on latest release, again, it takes us to the BLS page where we have tables and text, and the easiest way to visualize whether inflation is rising or falling is by looking at the charts. So we'll scroll down and look at news release charts. Okay, so if you look at the charts here and you click on 12 months percentage change over the past 20 years, click go. You can see the historical performance of inflation on an annualized basis. So we are looking at all items here. And if you look at all items less food and energy, right, although the color scheme is not so great, we have dark red or brown and we have a lighter shade of red here. So you can see both headline inflation and core inflation have been rising. And after headline inflation peaked June of in June at 9.1%, it's been falling pretty steadily, whereas core inflation, which doesn't include food and energy, has taken a longer time to pull back. So as you can see, the latest readings here are for the month of February, and the next one, which the next data point will be March, and that data is being released today at 8:30 p.m. UTC +8. So if headline inflation on an annualized basis drops to lower than 6%, and for core drops to lower than 5.5%, that means naturally inflation is falling, is continuing to fall, and that bodes well for the Fed because it makes their job easier. So it's very likely that moving forward in May, they may not consider hiking interest rates because if inflation is continuing to fall, then for them to keep interest rates at 5% is probably the next best thing to do. So what this means that markets will anticipate that the dollar will weaken and bond yields will fall. Now, why this is happening? Because when markets are expecting the Federal Reserve to be less hawkish, the dollar will fall and the bond yields will also fall. So if you look at this chart here, when inflation peaked in the middle of June 2022, it's about the same time where the dollar index also peaked and bond yields also peaked. So now with that, we shall look at the charts, okay? All right, so this is a DXY chart. Let's just go to a weekly chart so it's easier to visualize what is actually happening. Okay, so as interest rates were being raised aggressively by all central banks, particularly the Federal Reserve, the dollar index was also rising. It went from 95 to all the way to about 115 in within 6 months. And similarly, let's just do a dual chart so it's easy to. Okay, right. Okay, so this is a dual chart here. So what I'll do is for this, I'll switch everything to weekly. The first chart, I'll put the DXY. Okay, and this chart below, I shall put the US 10-year bond yield. Okay, so this is a nominal United States 10-year government bond yields, which is a good indicator of where of what the market expects in terms of interest rates. Okay, so as you can see, at the start of 2022, the Federal Reserve was raising interest rates aggressively due to rising inflation. Bond yields were rising from about 1.5% all the way till to the middle of to June to about 3.5%. And similarly, The dollar index also rose from 95 all the way to July, June, July, hitting about 110. And after a slight pullback, the Federal Reserve was still raising rates, and bond yields and the dollar index made new highs. So this is important because as inflation is rising, the Fed has only one tool or a couple of tools in their toolbox to combat inflation, and that is to raise, one of them is to raise interest rates, and the other is to reduce their balance sheet. These are the two primary tools that they have, or these are the two main ones that's easier to understand for all of us. So in this period, when you have rising bond yields, rising dollar index, naturally, it means all the major currency pairs, your Aussie, your Euro, your Pound, your Kiwi, your CAD, your Swiss franc, and your yen, they're all going to weaken considerably against the dollar. So this is a period where it would be, you would be looking to long the US dollar for most periods, right? Of course, there are pullbacks along the way because this is, mind you, this is a weekly chart. Definitely there'll be retracements along the way, but you can see the general trend was strength in the dollar, right? So when you have strength in the dollar like this, you'd be looking to go long at any pullback in the dollar, in the strength of the dollar. And as we know, inflation peaked around June, July, and that's when market expectations also reversed, despite the Federal Reserve raising interest rates and keeping them high. Bond yields actually started to pull back and range between 3.4% and about 4%. In that same period, the dollar index has dropped significantly, right? You would think that with the Fed keeping interest rates at this, which was at this time maybe about 4.5%, and raising it to 4.75 and now finally 5, you would think that the dollar would still remain strong. But no, in fact, actually the dollar has sold off very significantly, or very significantly, while bond yields have more or less stayed within 3.5 and 4%. So what this tells us is markets are expecting the Federal Reserve to eventually pause and cut rates. So basically from this point onwards, in the third quarter or fourth quarter of last year, the dollar, naturally as the dollar index falls, all the other currency pairs have gained against it, right? So despite the Federal Reserve keeping interest rates high, the dollar has actually weakened. So if we just quickly look at, okay, so let's keep the top one as the dollar index. I will switch the bottom one to Aussie. So similarly, as you can see that with the crosshairs, right? This is a weekly chart. So as the dollar index fell, despite the Federal Reserve raising rates, the Aussie gained, right? Because the Aussies were still, the Australian Central Bank, Reserve Bank of Australia, was still increasing rates. Federal Reserve was still increasing rates, but the dollar was actually selling off. So it's important to notice these changes in price points. And now you can see that we were in a period of downtrend for the dollar from October all the way till end of January this year, before it pulled back up again, retraced higher, and then finally coming back down again. So similarly, if you were to look at, oh, wait, hang on, let me keep this as DXY, top chart DXY, bottom chart, switch to Euro. So similarly, it tells the same story again. With dollar index falling, the Euro started rising significantly, right? Similarly for pound, same story here. Kiwi, also you see a similar story. And let's just look at the last one, which is the dollar yen, right? Okay, dollar yen is a very interesting example because you have two very divergent central banks. You have the Federal Reserve, which was actively raising interest rates, and not only actively, aggressively raising interest rates from the start of 2022, whereas the BOJ, or Bank of Japan, have been in a perpetually in a negative interest rate environment. So there's a big divergence in monetary policy between the two central banks as of 2022. Fed was increasing rates aggressively, going as high as 5%, whereas the BOJ kept interest rates at negative 0.1%. So you would think that with this monetary policy in place by the respective banks, you would think that dollar yen would continue to shoot higher. But no, actually, in fact, the dollar yen peaked at the same time as dollar index, and it's basically a mirror image of the dollar index, right? So this is because the yield differential between the US and Japan started to fall. So now I'll show you how we can use TradingView to help us chart the yield differential. Okay, so the yield differentials between countries, and we will actually help us determine the general trend in the currency pair, and also potential turning points, and also identify long-term trends. So once you know where the turning points, where the long-term trends, you're able to zoom in on daily charts, for hourly charts or hourly charts, and uh, use your appropriate or your preferred trading strategy and style. Okay, so what we're going to do is on the top chart, we'll change it to the US 10-year yield. So just type US 10Y, right? So this is the United States 10-year government bond yields. Okay, so that's the top chart. Bottom chart, we're going to change it to Japan. So that's JP, I believe 10Y. Yes, okay, so JP 10Y. So that's the Japan 10-year government bond yields. Okay, so right now you can see with respect to bond yields, the dollar for the US dollar from the start of 2022, it was about 1.6, 1.7, was rising steadily throughout the year, peaking at about 1.43%. So this is for the US 10-year. And similarly, for the Japanese yield, 10-year yield, it was relatively stable at about 0.2 to about 0.25%, right? And it was only here in December when Japanese bond yields really shot up. Okay, this was due to some central bank intervention. I forgot what it was by BOJ. Yes, okay, I remember now, because the dollar yen had moved far too high, and because of certain requirements by the Bank of Japan, they had to strengthen the value of the yen. So when they strengthened the value of the yen, there was a big intervention by the Bank of Japan, and this intervention caused Japanese bond yields to spike. So when we had this spike in Japanese bond yields, that's when the yen also strengthened pretty considerably. Okay, so now what I will do is for the bottom chart, I will take the US 10-year bond yield minus the Japanese 10-year bond yield. So the good thing about TradingView is not only can you view the individual charts for bonds, for currencies, especially for bonds, you're able to do the yield differential as well. So just as simple as typing US 10Y minus JP 10Y will give us the yield differential between the United States and Japanese government bonds. So this bottom chart here is showing us the yield differential. And just to put things, and what we'll do, we'll change the top chart. Sorry, we'll change the top chart to dollar yen. Right. So as you can see, they are actually practically a mirror image of each other. So in the sense that if you wanted to know the direction of any currency pair, it will be good to look at the yield differential as well for that particular pair. So for dollar yen, you look at, of course, the US and Japanese 10-year bond yields. For Euro USD, you would do it similarly for European yields, or maybe the German and French 10-year yields versus the US 10. Aussie, same thing, you do Australian 10-year bond yields minus US 10-year bond yields. So by actually tracking the yield differentials together with inflation, right? You see where inflation is heading. Okay, you can see inflation has peaked. Right now I'm on the chart, on BLS chart, where inflation has peaked and dropping. So as inflation is falling, this sets into gear, sets into motion that markets are expecting the Federal Reserve to be less hawkish. Although the Fed will still raise rates, but the hawkishness or the less hawkishness is actually displayed in the movement of bond yields. So that's why it is important to track bond yields, bond yield differentials together with inflation data, employment data, ISM reports as well as GDP, right? So once you have this few fundamental data points, right, it actually helps you paint the overarching picture of what currencies are doing, what bond yields are doing, and what central banks are doing. And basically, it gives us a relatively good idea of the state of the economy for each respective country. So as you can see, okay, so bottom chart here is the yield differential. So from the start of 2022, the yield differential between the United States and Japan was rising aggressively. Of course, there'll be pullbacks along the way, consolidation, range-bound period as well between here, May and August as well, right? But the dollar yen continued pushing all the way till 150, right? Look at it, it broke 150. Now, because of this price, this movement in price, the BOJ had to intervene. There was a big intervention action by them, which led to Japanese bond yields to spike, despite interest rates being kept at negative 0.1%. So the BOJ didn't alter their interest rates, but they actually intervened in the open market, right, by buying Japanese yen. And when they bought Japanese yen, the yields of Japanese bonds increase. So as this happened, as Japanese bonds yield on the Japanese bond increases and the yield on the dollar stays steady or starts to drop, you will see the yield differential start to fall. So if you are observing the yield differential and paying attention to what the BOJ did with regards to their intervention policy and looking at this DXY and subsequently putting everything together, you will get a complete picture or an overarching picture of why the dollar weakened, why the US 10-year yield dropped, why the Japanese 10-year yield increased, and then subsequently you would see the fall. You would understand the fall in the yield differential. You would understand the sharp pullback in dollar yen as well. So during this period, didn't matter whether Federal Reserve kept raising interest rates or whether Fed's interest rates were at 4.755% and Japanese interest rates were at negative 0.1%. If you just look at interest rates differential, it's still in favor of the United States, but that's not reflected in the price of, or not the price, but that's not reflected in the yield on the bonds. It is not reflected in the strength of the dollar, and it's not reflected in the currency pair itself. So that is why it is important to look at about 4 or 5 fundamental indicators, and this will actually help you to paint the larger picture, right? Because we are looking at weekly charts here. It helps you to paint the larger picture, help you determine turning points in currencies by looking at central banks' action, looking at bond yield differentials, looking at inflation, and plus other information, right? You don't need to look at everything because there's simply too much, right? It's as a individual trader or retail trader, right? There's so much info out there. So what do you look at, right? What do you focus on? So I would say look at what the big central banks are doing. Look at where their interest rates are. Look at where inflation is. Look at where GDP and unemployment figures are. right? At least this all this data comes out on a monthly basis. So it's not like something. It's not that something we need to track regularly, but then pay attention to the bond yield differentials, right? Because they will signal potential turning points in the currency pair. So that is why I like to use the dollar yen in this example for to illustrate the importance of bond yield differentials, the importance of intervention by central banks, despite the respective interest rates still being very divergent, and to understand why certain moves in FX occurs, right? So once bond yields, the bond yield differential peaked and started heading lower in favor of the Japanese yen, the dollar yen also fell just significantly, right? And then it fell, yeah, from 150 to as low as 137. And then as the differential picked up again in favor of the United States, this was another turning point here, right, on the weekly chart. It didn't go lower. It actually formed a base here, and the yield differential started driving higher. So this would have been a clue to indicate that, okay, there's a potential change in direction, and we could expect the dollar yen to uh, retrace some of the losses that it has made. And likewise, again, as inflation expectations also continue to drop, with inflation uh, continuing to print lower, headline inflation and core inflation continuing to print lower, bond yield differentials, bond yields in US also started falling, and likewise, this is reflected in the yield differential, and hence the dollar yen fell, right? Okay, so I think these are some of what I've covered is basically where to look for fundamental data, which are the key US fundamental data to look out for. And similarly, you could do that for other currency pairs, but that might be, you know, frankly, that's probably a bit too much work, right? Just looking at the US alone is takes up quite a fair bit of time for an individual person. So just maybe perhaps I would say concentrate on the US, right? Macro data. So look at GDP numbers, look at ISM numbers, and especially look at prices because they will tell us where prices for the services and manufacturing sectors are heading. And this relates back to overall inflation. Look at employment numbers, right? Look at how strong the labor market is in terms of total non-farm and in terms of how low the unemployment rate is. And also look at inflation, whether inflation is trending lower. Is it staying constant, consolidating, or is it starting to pick up again? And ultimately look at bond yields, right? The bond yield differential, right? So, are there any questions, or would you like me to revisit any particular topic or any uh, particular part of this webinar? Right. Okay. Otherwise, I can move on to something else, right? Something else that's coming up big today. So we have, as we've mentioned, we have the okay, let's just zoom in to yes, so of course. So today, 12th of April, 8:30 p.m. UTC +8, we have US inflation data being released. So this is going to drive a lot of the moves in FX and equities and gold later this evening. Well, in Singapore time or in Asia time will be evening, right? So in about 1 hour 40 minutes, right? Doesn't matter where you are, in 1 hour 40 minutes is where we will see a lot of big moves in currencies, currency pairs, in gold, and also in um, equities, right? So just as a quick, okay, so since we're talking about gold and inflation, okay, let me switch this to DXY. Okay, again, we are looking at weekly charts. So the top chart is showing us DXY, the dollar index. Bottom chart is showing us now gold. Okay, so Let me get rid of volume. Okay, right. So since we are talking about inflation, uh, I think, and we have a big data point coming out this evening, right, on a very short time. I think it's good to cover this as well. So if we, what we're looking at now is the weekly chart. On the top, you have the dollar index. Bottom, you have gold. Okay, so similarly as 2022 began, uh, central banks started, the Federal Reserve started raising rates aggressively. Dollar index shot up, bond yields increased, and also uh, the geopolitical event occurred. Like, right, we had the invasion of Ukraine by Russia, so that created a big demand for gold as uh, as a safe haven asset. So that drove up the price of gold in the first quarter of 2022. But what happens during this period also is, it is important to note why. It's also something to take note. Why did um, gold fall after a major geopolitical event? You would think that investors, central banks would continue to buy gold and drive it higher. But actually, because we know that the strength of the dollar is inversely correlated to gold. So as the dollar increased, right, despite there being a major political event, geopolitical event, the strength of the dollar actually caused, is not the only reason, but it's one of the reason that caused this the price of gold to pull back very significantly. So this is also to do with combination of dollar strength and combination of what we call real yields. Okay, real yields are 10-year bond yields adjusted for inflation. Okay, so what that what that what has happened is, in this period when the gold peaked 2050, 2060, went down as low as 1600. During this period, real yields were actually rising. So when real yields rise, uh, together with the strength of the dollar, this negatively impacts the price of gold. But then the dollar index peaked in October, right? At the same time, gold bottomed, and as the dollar pulled back significantly, and as interest rates, as inflation started to pull back as well, real yields turned more negative, right? I don't have a chart for real yields here, but just try and visualize it. So as real yields became more negative, together with falling dollar, falling inflation, gold became a more attractive hedge against inflation. So what I'm trying to say is basically in this period, as dollar index strengthened, bond yields strengthened, gold is generally not a good hedge against inflation. Hence, that's why we saw the sell-off in gold. But after that, the macro picture changed, whereby the dollar index started falling aggressively. Inflation also started falling a little bit. Bond yields started falling. And in this environment, bond becomes a better hedge. Gold becomes a better hedge against inflation. Hence, we see the bid up in gold here from about 16,000, 1600 all the way to almost breaching 2000 here in January, and before pulling back again because as the dollar rose, it negatively impacted the price of gold. And also we had the banking scare here, right, in March. So in early March, we had the fallout from Silicon Valley Bank, Signature Bank in the US. Plus, we also had major issues in Switzerland, coming out of Switzerland as well, with UBS eventually having to take over Credit Suisse. So we've also had a banking crisis here, which sparked a drive uh, for gold as a safe haven asset. So as we see dollar index continue to fall, bond yields continue to fall, we may see gold stay elevated around this level. So which brings us to this um, uh, CPI event coming up. So if CPI, so there's several factors to look at CPI. You've got headline CPI, which contains all the components, and you've got core CPI, which doesn't include food and energy. So they'll be looking at the monthly growth of headline and core CPI. They'll also be looking at annualized growth or the year-over-year growth of headline and core CPI. So if these data points, there are four major data points to look at. So if as a whole, they all print softer than their estimates, that means they come in lower than all their estimates on a monthly basis, on an annualized basis, and also compared to the previous month, it is very likely that bond yields will drop, the dollar index will drop, and this would potentially create another tailwind for gold. Conversely, if inflation comes in hotter than expected across all four metrics, then it's very likely that bond yields will rise. Dollar index may rise as well, but if bond yields rise aggressively, this would potentially cap any further gains on gold and may drive it lower. Right? Okay, so not only have we covered fundamental strategies for forex, we've also looked at a bit of gold because it all interrelates with each other, right? You look at forex, currency pairs, you look at bond yields, you look at inflation, you look at dollar index, the strength of the dollar, the weakness of the dollar. You look at bond yield differentials, use the 10-year bond yields and the differential between the countries to see where um, price is headed, where the major turning points, where the major inflection points, and look out for central bank announcements, what they are doing. And yeah, this would help you picture piece everything together to form a large picture. And then once you have it, once you know what the overarching uh, theme is or the environment is, you are able to scale down into daily charts, 4-hourly charts, and hourly charts. So what I've presented here is mostly through weekly charts. So at least we are able to understand the trends, the longer term trends, and also potential turning points, right? Okay, so um, I've come to the end of today's webinar. I hope this has been a good session for everyone. And if there are any questions, feel free to fire away in the chat. And yeah, I'll stick around for I guess a minute or two. And if you have any questions, please let me know whether it's something about CPI today or if it's something about what we've discussed recently. I mean, discuss in this session, or would you like to clarify any other points or any other topics? Wait, so sorry. Okay, Howard. Okay, there's a question I completely missed this. Okay, sorry. Okay. On the day of this release of manufacturing PMI data, does the dollar move the same way? No. Okay, wait, I'll type the answer. So basically I'll type the answer to Howard and also explain it live as well. Okay, his question is on the day of the release of manufacturing PMI, does the dollar move the same way the NFP data moves the data? Okay, so generally speaking, PMI numbers are important, but they don't have that much of a significant move in currency market. I mean, it will drive sort of the longer term movement, but on the day of release, it's not as impactful as NFP. NFP data releases tend to have more or not tend, they create more volatile instances rather than PMI releases, right? So I think that's different. That's something to understand as well. So different news events have greater significance and introduce higher volatility than others. Okay, so also just type the answer as okay. I'll just answer it. I've already answered it. Yep. Okay, then so- right. Okay then. All right. Okay. Yeah, okay. So I've come to the end of the webinar. So yes, so I hope you guys have found this useful. And remember, it's about trying to understand the big picture so that we can scale down and zoom down into your particular your favorite time frame, and then you are able to uh identify trading opportunities, be it on the short or long side, and then try to successfully create high probability trades and trade outcomes for yourself. All right. Okay. Thank you, everyone, and yeah, have a good trading week. All right. Take care, guys and ladies and gents. All right. Bye.